JPX energy market weekly updates. Oil prices have trended high during the second part of last week. Prices eased back from recent gains Friday and Monday as China imposed COVID restrictions on a growing number of cities, but benchmark prices were still looking at weekly increases of 3%. The bullish price action was fueled by a number of factors, including optimism over record U.S. crude exports, signs that recession fears are fading, and a weaker U.S. dollar. Longer-term traders also noted that the start of OPEC+ production cuts and European Union's embargo on Russian crude oil was also underpinning fundamentals. This is reflected in a more steep backwardation structure at the front part of the future curve. Intermonth spread continued to improve, with the key January and March spread of JPX Dubai contract up 80 cents to $4.10 a barrel. U.S. crude oil stockpiles rose in the most recent week. Crude inventories rose by 2.6 million barrels in the week to October 21st to 439.9 million barrels, nearly triple analysis forecast in a Reuters poll for a 1 million barrel rise. The big surprise that drove prices higher was, however, the news that crude exports surged to a weekly record of 5.1 million barrels per day, cutting net crude imports to just over 1 million barrels per day, also a record. Crude oil was also underpinned after the latest U.S. GDP report showed some signs of inflationary pressures could be ceasing. The report for U.S. GDP showed a 2.6% economic growth in the third quarter. On the supply side, Russia's finance ministry has slashed its forecast for taxable oil production for next year, a draft budget seen by Reuters show on Friday. The draft budget covered the next 3 years and forecast a decline in crude oil production and refining as Western sanctions spiked. The finance ministry sees Russian oil and gas condensate production at 490 million tons next year, or 9.84 million barrels per day. This is a 7 to 8% decline from the 10.54 to 10.64 million barrels per day that the ministry anticipated this year. After the drop-off to 490 million tons next year, the finance ministry expects oil production to increase to 5 million tons for 2024 and 2025. Oil refining and export volumes that are subject to tax have been revised down to 8.2 million barrels per day next year from the previous expected 10.15 million barrels per day. Of this, expected oil refining volumes were cut by nearly 20% to 230 million tons, while oil exports subject to export duty were revised down by 19.4%. So far, Russian oil production, the third largest after the United States and Saudi Arabia, has been resilient to sanctions, buoyed by rising sales to China and India. However, uncertainty surrounding the impact of Western ban and the implementation of price cap on Russian oil from December the 5th are giving pause to China and India's appetite for Russian crude oil. Refiners and crude buyers from both of these key Asian markets for Russian crude oil are unsure as what to expect post-December the 5th, and this was reflected in the little-to-no trade information heard from December loading Far East Russian barrels. The crude oil market in Asia typically trades 2 months ahead of the loading cycle, which sees buyers and sellers in Asia trading December loaded barrels in October. Another near-term uncertainty for the oil market comes from the policy uncertainty brought by the midterm elections in the United States, as U.S. House Republicans will launch an investigation into what they say could be a potential misuse by the Biden administration of the nation's emergency oil reserves to lower gasoline prices, as well as the White House considerations over a fuel export ban. However, the event this week which will have the biggest impact on the oil market is the Fed meeting. Expectations that the Fed will hike interest rates by 75 base points. However, the market will also be eager for any signals on what the Fed could do at its December meeting. There's a growing expectation the Fed could slow the pace of hikes in December, and its hints from the Fed of a slowing in the pace of hikes will likely provide some support to risk assets, including the oil markets. Okay, that's all we have for this week. Welcome back next week.